How are you? And welcome. Let's check in with Andre first.
What a crazy week it's been. President Donald Trump announced tariffs on Canada, Mexico, and China. The stock market went down. Bitcoin dropped. People called Mr. Trump crazy for imposing these tariffs on our neighbors, but then Canada caved, Mexico caved, the US canceled the tariffs, and the markets went up again, and now you're all caught up. Except there's a 30-day delay on the tariffs now, and they could be coming back, so when they do, I want you to understand what's happening, because a lot of people are scared right now that this will make the price of stuff go up, but I'm here to tell you that that's not always the case. So if you're someone who's just trying to invest their money and you're trying to understand what the heck is happening, I'm going to break down the trade war, what it means for the economy, and what history tells us about similar situations. But I also want to go deeper because behind this trade war is something so much bigger: the fate of the US dollar and the possibility of something called the Plaza Accord 2.0 and what that means for stocks, real estate, Bitcoin, and your portfolio. Because the truth is, right now, on the global economic stage, there's a game of 4D chess that's being played right in front of us, and that's what I want to help explain. So let's get into it.
Cool.
Hi, my name is Andre Jick. Hope you're doing well. It's a classic Trump strategy. Maximum pressure, maximum chaos, and then ultimately, boom, art of the deal, weaken the dollar. So the question is, what happens to stocks and real estate and Bitcoin and all these other assets? They tend to go up. Stocks tend to benefit because lower interest rates make borrowing cheaper, which boosts growth stocks, tech stocks, and high debt companies. And historically, stock markets prefer when the dollar is weak because companies that export goods, like Apple and Tesla, become more competitive. Real estate benefits because lower rates means cheaper mortgages, and investors that want to protect their buying power might also flood their money into hard assets like property. Bitcoin and gold are apex predators in the domain of property. That's why gold just hit an all-time high recently. And as fiat currencies weaken, people look for alternatives that hold their value over time. That's what I think the smart investors see. I think that's a really interesting theory. Now, the real big takeaway is that on a personal level, cash is probably going to lose purchasing power in this scenario. Investors who sit on too much cash while the dollar weakens could see their savings eroded, possibly by inflation, but definitely by asset values going higher. If this theory plays out, we're looking at a future where the financial system changes in a really big way. The US could be heading toward a long-term period of lower interest rates and a weaker dollar, high growth, similar to what happened after the original Plaza Accord. And if that happens, the biggest winners will be those who hold assets. But anyone who relies on things like fixed income savings or an income that doesn't keep up with inflation will unfortunately be left behind. But all of this is, of course, allegedly for entertainment purposes only. If you found this breakdown helpful, smash the like button, subscribe if you haven't already. I hope you have a wonderful rest of your day.
Next, let's head over to Yahoo Finance, see what they got to say.
Well, the 10-year Treasury yield hovering around the lowest level that we've seen in just about a month, following some commentary that we got from Treasury Secretary Scott Bessent. He spoke with Fox Business yesterday, saying that President Trump is, quote, not calling on the Fed to lower rates. They're not worried, not focused on what the Fed is doing, but rather they are focused on the 10-year Treasury yield. For more on this, I want to bring in Ed Mills. He's the managing director at Raymond James. Ed, it's great to have you back here on Yahoo Finance. So certainly some of that rhetoric and some of the comments that we got from Bessent certainly had and do continue to move the market here this morning. My question to you is, when you take into account what the administration wants to see happen, they want to see lower yields. Is that possible given the policies, especially the tariff policies that are and do seem to be coming out of the administration?
Yeah, Shauna, it's an important question. And I do think that when we look at the Hill and what they want to do on tax cuts, another really important thing that came out of that interview yesterday was a continued insistence by the Treasury Secretary that the Trump tax cuts from 2017 are going to be made permanent. To do that, that adds more than $4 trillion to the debt and deficit over the next 10 years. There is also a desire to go beyond that: no tax on tips, no tax on Social Security, overtime, changes to SALT. Now we're more than $5 trillion. If we see a bill that would add to the debt and deficit by more than $5 trillion, it is going to be a challenge to keep the long end of the curve down. One of the things that I would also look at, Shauna, is if there is something that the Treasury Secretary has some authority over, versus the Fed funds rate is Treasury yields. And what we saw over the last couple of years is under the Biden administration, Treasury Secretary Yellen changing the way in which they refunded treasuries that put downward pressure on the 10-year that allowed for us to seem as if inflation was not running as hot. Can they continue that? My bet is they actually have to issue more 10-year treasuries, which will be a difficult part of keeping that lid on the long end of the curve. And so I think the threat of a government shutdown is actually pretty high come March 14th. What we can do with the debt limit becomes in doubt. And the longer we're under the debt limit, it might be Scott Bessent's wish, because what we saw in 23 is that the longer we're under the debt limit, the more pressure was on long-term yields. But once we lifted that debt limit, we had to issue a bunch of treasuries and yields spiked higher. So it might be short-term benefits to long-term pain, and a huge distrust right now, Shauna, between congressional Democrats in this Trump administration. I'm sure it can go lower, but it's hard to see it much lower than it is right now.
I agree with you there. All right, Ed Mills, great stuff. Thanks so much for taking the time.
What's up, you guys? It's Graham here. So it finally happened. Breaking news. We now have an official outline on Donald Trump's potential tax cuts. And I gotta say, this could wind up saving most of you watching a lot of money. In fact, he just laid out 6 categories that could soon get a complete overhaul. And that's why it's crucial that we break down exactly what's outlined, what this means for you, and how much money you could see back in your pocket at the end of the day. Because no joke, this could be the biggest tax adjustment that we've seen in almost 10 years. Although really quick, if you enjoy videos like this where I just try to get you the information as fast as possible, even if that means I had to cancel plans to get you this video out on time, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. And as a thank you for doing that, I'll do my best to reply to as many comments as I can. So thanks so much, and also a big thank you to Incogni for sponsoring this video, but more on that later. Alright, so to start, let's just get right into it. In 2017, Donald Trump passed what's called the Tax Cuts and Jobs Act, which lowered taxes for practically everybody across the board, reduced corporate income taxes, and provided some pretty substantial benefits for anybody who was self-employed. However, these were all scheduled to expire by the end of 2025 if nothing was done. And as I'm sure you could see, something is currently being done as we speak. Or I guess as I speak. And these are the proposed changes. According to the Wall Street Journal, Trump outlined 6 tax priorities, with the first being no tax on tips, Social Security, or overtime pay. So let's start with tips. If passed, this would either change the definition of tips so that it's not treated as income, provide a tax exemption against tips, or provide a tax deduction against tip income when a person goes and files their tax return. On top of that, most people don't realize that this was actually a proposal introduced in 2024 by Senator Ted Cruz, and in it he stated that there shall be allowed as a deduction an amount equal to the cash tips received during the taxable year that are included on statements furnished to the employer. Or basically, since that's really confusing, all that means is that if you were to get $5,000 in tips, you would get a $5,000 deduction on your tax return. Basically, think of it like this. Remember when you were a kid and you'd come up with some crazy idea with your friend, and then you'd go to your friend's parents, pitch the idea, and if they say yes, then you could go to your parents and say, hey, we came up with this idea. Their parents said yes, so you should say yes too. Well, that's basically the same thing that happens here, except with Congress and your entire livelihood. Now, in terms of all of this actually passing, it's a good chance because Republicans currently have the majority control of both the House and the Senate. So we're probably going to see a watered-down version of everything we discussed potentially going into effect as soon as 2026. We're obviously going to have to stay tuned to see exactly what happens, but if you want to keep updated on this, please feel free to subscribe. I will do my best to update you anytime there's news. Thank you so much for watching. As always, remember to hit the like button and subscribe.